The Bank of England has just issued one of its clearest warnings in years. And unlike the dramatic headlines we sometimes see in the news, this warning comes from the people whose single job is to quietly, carefully watch the financial system for signs of danger. Twice a year, the Bank of England releases something called the Financial Stability Report. Most people never read it. It's long, technical, and not designed for general audiences. But inside this latest report, published just days ago, the bank made it clear that the UK and the world may be heading toward a serious financial shock. And this time, the threat isn't coming from the places most people expect. It's not just inflation. It's not a housing collapse. It's not bad government spending. Instead, the bank is warning about something new, something that has grown so quickly it now touches almost every part of the global financial system. The rise of artificial intelligence, the trillions being poured into it, and the enormous amount of debt now supporting that boom. According to the Bank of England, a massive AI-driven financial bubble may already be inflating right in front of us. And the way it's being funded could turn a market correction into a global crisis. And the bank didn't leave this as a vague warning. In its own words, it laid out exactly why the financial system is now more exposed than before. The language is unusually direct for a central bank, and it makes the seriousness impossible to ignore. Risks to financial stability have increased during 2025, with global risks remaining elevated and significant uncertainty persisting in the global macroeconomic outlook. Key sources of concern include geopolitical tensions, fragmentation of trade and financial markets, and pressures on sovereign debt markets, while heightened geopolitical tensions also increase the likelihood of cyber attacks and other operational disruptions. In the FPC's judgment, many risky asset valuations remain materially stretched, particularly in technology companies focused on artificial intelligence, AI, with equity valuations in the US nearing levels last seen during the dot-com bubble, and in the UK approaching those of the global financial crisis, raising the risk of a sharp correction. At the same time, the role of debt financing in the AI sector is expanding rapidly as AI-focused firms pursue large-scale infrastructure investment, with some industry estimates suggesting that AI infrastructure spending over the next 5 years could exceed $5 trillion, while hyperscalers will fund much of this from operating cash flows. Around half is expected to be financed externally, mainly through debt. These deeper links between AI firms and credit markets, along with increasing interconnections across the sector, mean that if an asset price correction occurs, losses on lending could amplify financial stability risks. Despite all of these mounting dangers, the Bank of England did something that surprised almost everyone who follows financial policy. And understanding that decision is key to understanding just how seriously the bank views the current risk environment. The bank actually decided to cut the amount of money banks need to hold in reserve to protect against shocks. On the surface, that sounds strange. Why would the UK's central bank reduce financial safeguards at the very moment it says risks are rising? The reason is simple. The bank believes that the risks facing the UK economy are increasing so quickly that businesses need more breathing room, more access to credit, and lower barriers to borrowing. Cutting the counter-cyclical capital buffer from 2% down to 1% is a way of giving banks more flexibility to keep lending during uncertainty. But this decision also signals something deeper. You do not loosen safeguards unless you see real stress building. And throughout its report, the bank makes it clear that the risk environment is deteriorating. Borrowing costs for the government are rising. Hedge funds are taking increasingly risky positions. The property market remains under pressure. But the most striking warning of all is the one that focuses on AI, the technology that everyone says will change the world, but which may also be creating one of the largest and most dangerous bubbles of our time. The bank explains that AI companies across the globe are now engaged in one of the biggest investment races in history, bigger than smartphones, bigger than cloud computing, and rivaling even the dot-com boom. By some industry estimates, AI infrastructure spending over the next 5 years could exceed $5 trillion. These investments are so large that even the biggest tech companies like Microsoft, Amazon, Alphabet, Meta, and Nvidia, cannot pay for all of it using cash alone. So they are turning to something else: debt. And not a little debt. According to industry estimates cited in analysis surrounding the bank's report, AI hyperscalers will continue to fund much of this from their operating cash flows. Approximately half is expected to be financed externally, mostly through debt. So, in simple terms, roughly half of the $5 trillion in AI investment will be financed through borrowing. That means the AI industry is becoming deeply tied to credit markets, banks, lenders, pension funds, hedge funds, and every institution that buys corporate bonds. In simple terms, AI is no longer just a tech story. It is a financial system story. This matters because when a sector becomes heavily dependent on debt, its risks spread far beyond Silicon Valley. If AI stocks fall, the losses do not stay inside the tech industry. They ripple through the banks that lent the money, the funds that bought the bonds, and the markets that depend on those companies for growth. And right now, the Bank of England is worried that AI valuations are getting dangerously close to bubble territory. According to the report, equity valuations in the US are close to the most stretched they have been since the dot-com bubble, and in the UK since the global financial crisis. This heightens the risk of a sharp correction. In simple terms, equity valuations in the United States, driven heavily by AI companies, are nearing levels not seen since the dot-com bubble in the late 1990s. And in Europe and the UK, valuations are approaching highs last seen before the global financial crisis. Andrew Bailey, the governor of the Bank of England, put it clearly: the AI sector is a particular hotspot. Almost half of the entire S&P 500's value now comes from AI-linked companies. That means if AI goes down, the entire market goes down with it. This level of concentration is rare, and historically, it has always led to extreme volatility. Before we move on, it's important to understand something. This concern about an AI-driven bubble isn't just coming from regulators or economists. Even some of the most influential people inside the tech industry, the people who are building AI, funding AI, and shaping its future, are starting to acknowledge the same pattern. When too much money floods into a new technology too quickly, the market stops distinguishing between strong ideas and weak ones. That's exactly what the Bank of England is warning about, and is exactly what we've seen in every major tech bubble in history. And interestingly, one of the clearest explanations of this dynamic didn't come from a central bank or a financial analyst. It came from Jeff Bezos himself. In a recent interview, he described what happens when excitement overtakes discipline inside the tech sector, and his words perfectly capture the moment we are in right now.
The second thing that happens when people get very excited, as they are today about artificial intelligence, for example, is every experiment gets funded. Every company gets funded. The good ideas and the bad ideas. And investors have a hard time in the middle of this excitement distinguishing between the good ideas and the bad ideas. And so that's also probably happening today. But it doesn't mean that anything that's happening isn't real. Like, AI is real, and it is going to change every industry. In fact, it's a very unusual technology in that regard, in that it's a horizontal enabling layer. Today we talk about AI first companies like OpenAI and Anthropic and Mistral and so on and so on and so on. There are so many startup companies that are kind of AI companies of various kinds. And that's normal for this phase. But that is not the biggest impact that AI is going to have. The biggest impact that AI is going to have is it is going to affect every company in the world. It is going to make their quality go up and their productivity go up. By every company, I literally mean every company, every manufacturing company, every hotel, every, consumer products company, et cetera, et cetera, et cetera. And so that is hard to fathom, but it's real. There is no doubt. We don't know how long it will take exactly. We don't know how quickly that transition will occur. It'll probably occur at different rates in different industries.
What Bezos said in that clip is exactly what the Bank of England is warning about. When every experiment gets funded and every company gets funded, the good ideas and the bad ideas, markets lose the ability to separate genuine innovation from hype. And when investors have a hard time distinguishing between good and bad ideas, that is the textbook definition of a bubble beginning to form. But the bank goes even further than Bezos here, because it highlights something far more dangerous beneath the surface. These experiments are not being funded with spare cash. They're being funded with enormous amounts of borrowed money. The AI infrastructure boom is being built on debt. And when hype mixes with leverage, the risks multiply in ways investors often don't see until it's too late. Bezos isn't talking theoretically. He's describing what is happening right now. And what makes his comments even more interesting is that he specifically mentions companies like OpenAI, Anthropic, and Mistral. OpenAI in particular has been under intense scrutiny this year, not just for the speed of its growth, but for the governance issues, funding controversies, and valuation swings surrounding it. When the world's most influential tech investor says the market can't tell which ideas are solid and which are risky, and one of the examples he names is OpenAI, that should get everyone's attention. This is why Bailey compared today's valuations to the dot-com era. Investors believed the internet would change everything, and they were right. But markets got ahead of reality. Companies with no profits or viable models saw their stock prices explode, only to collapse when the bubble burst, wiping out trillions. The bank suggests a similar pattern may be forming around AI. Yes, AI will transform industries. Yes, giants like Nvidia, Microsoft, Google, and Amazon are building world-changing technology. But that doesn't mean every AI stock deserves sky-high valuations, or that companies should borrow trillions to chase growth at any cost. A clear example of this is OpenAI, the company headed by Sam Altman. The cost of its compute commitment, the AI infrastructure such as chips and servers that power its world-famous chatbot, is $1.4 trillion over the next 8 years, a figure that dwarfs its $13 billion in annual revenues. Over the past week, this gap has appeared chasm-like, becoming a backdrop to market nerves over AI spending and statements by OpenAI executives that did little to answer concerns. The truth is, this level of spending is not financially sustainable, not under any conventional definition of a healthy business model. When a company projects $13 billion in annual revenue but commits to $1.4 trillion in infrastructure costs, the gap isn't just large, it's mathematically impossible to bridge without extraordinary intervention. No business can organically grow its way into covering 100 years' worth of expenses in less than a decade. The only way this model survives is through endless waves of external financing, new investors, new loans, new debt instruments, and the assumption that future profits will be so enormous that today's losses won't matter. That is exactly the type of thinking that inflated the dot-com bubble and the 2008 housing bubble. OpenAI, like many AI-focused firms, is being financed on the belief that AI will rewrite the global economy. But belief is not cash flow. If AI adoption slows, its competition intensifies, or if regulators step in, the projected revenue growth collapses, while the debt remains. And once debt becomes unpayable, it becomes destabilizing. This is why the Bank of England is warning so forcefully. The financial architecture being built around AI relies on optimism, not on proven returns. And optimism alone cannot service trillions in borrowing. This brings us to the most important and most underreported part of the Bank of England's warning: the role of debt. The bank says AI firms are relying more and more on external financing. They aren't funding this boom solely from their profits. They're issuing debt, taking loans, raising capital through credit markets. That means banks and lenders are now holding a huge amount of exposure tied directly to AI companies. If the bubble bursts, many of those lenders could face losses. And if lenders face losses, they may pull back from lending entirely. That can create a credit squeeze. A credit squeeze slows business investment. Slower business investment slows growth. And slowing growth, combined with major market stress, can push economies into recession. The bank's financial stability report also highlights the broader environment in which these risks are forming. The UK economy is still dealing with high interest rates. Businesses are cautious. Borrowing costs remain elevated. Household budgets are stretched. And government debt is becoming more expensive to service. In this type of environment, any additional financial stress, especially one coming from global markets, could cause serious damage. The bank's decision to lower capital buffers reflects this concern. It is trying to give banks more room to support the economy if a downturn arrives. But the reduction also means that the system has slightly less protection if a big shock hits. It is a delicate balance. So, what does this all mean for ordinary people? The Bank of England is effectively warning the public that the next major financial crisis, if one occurs, might not come from the housing market or from consumer debt or from government policy failure. Instead, it may come from a sudden collapse in global tech valuations tied to artificial intelligence. And because the AI sector is now so heavily funded by borrowing, trillions in loans, credit lines, and debt-backed expansion, a collapse in valuations wouldn't just hit stock prices. It would raise immediate questions about whether these companies can repay what they owe. A crash in AI stocks could drag down global markets. Falling markets could hurt pensions. Banks could see losses. Lending could tighten. Business confidence could fall. And the economy could slow sharply. In short, AI is booming, but it is also borrowing. And if the AI bubble cracks, the financial system could feel it far beyond the walls of Silicon Valley. The Bank of England's warning is simple. Prepare now, because the world may be closer to a financial shock than anyone wants to admit. If you found this helpful, don't forget to like, comment, and subscribe.